What is up? Welcome back to another video. In this video, I'm going to be talking about fair value gaps again, but more specifically, I'm going to be focusing on inversion fair value gaps because I haven't actually spoke about them a whole lot. So, first of all, I'm just going to quickly go over what an inversion fair value gap is, and it is pretty simple. So let me just find an example on the chart for you. So if we just go to the daily time frame, because I know there are lots of inversion fair value gaps. If we go to the daily time frame, all a inversion fair value gap is a fair value gap. So for example, here we have a fair value gap, and then what I mean by an inversion fair value gap is just when price disrespects a fair value gap. So for example, this is a bearish fair value gap, and as you can see, price does not respect the fair value gap, and we get a body close above the candle. So as soon as that happens, that is when the fair value gap gets disrespected, and that is what I call a inversion fair value gap. Now, what do I use inversion fair value gaps for? So inversion fair value gaps are how you find your entries in the market. So as you can see here, we have this inversion fair value gap, and now it has been violated. So what do I think is going to happen? I think price is going to go to here, buy side liquidity. Now, let's say I was entering into a position, and the way I would tackle this specific trade would be, if I was going to look for this buy side liquidity, I would wait for the fair value gap to get inversed. Now, what I would do is I would enter the trade as soon as the candle has been inversed. So I'd enter right here. My stop loss would be if price action came back and closed below this inversion fair value gap again, and then obviously my take profit would be the liquidity points. So yeah, that is how I enter and tackle inversion fair value gaps. Now if we go to the 5-minute time frame, and let's just go to Friday, which is the most recent trading day. It's currently Sunday. So if we're looking at Friday and we're looking at this price action right here, which is just the 9:30 open on Friday, as you can see, we have a fair value gap here, we have a bullish fair value gap here, and a bearish fair value gap here. Now, there is two possible trades that we could enter in with these, knowing that these two fair value gaps are here. We have this potential short setup here. So as you can see, price violates this fair value gap right here. So our stop loss would be a close back above here. And then we have this potential trade here, which inverses this 5-minute bearish candle. We get a candle close above. So our entry would be there. Our stop loss would be a close below. So now, the reason why I would not take this specific sell in this model is just because we need a higher time frame narrative. And now, as you can see, if we go to the daily time frame, we are extremely bullish on the daily time frame because we have inversed these fair value gaps here. So what that is telling me is that we are most likely going to go for the buy side liquidity. So when it comes to using inverse fair value gaps, you need lots of narrative behind it. You cannot just take any inverse fair value gap you see in the market, because then you will end up losing. This strategy actually takes a lot of screen time, and you need to journal and just see which inverses work and which inverses don't, because as you can see here, we have another fair value gap here. As you can see, this is inversed, and then price does not respect it, and price just goes the other direction. So let's go to another day of trading. So let's go to Thursday. and let's look for any potential inversion setups and talk about them. So if we were trading this day here, what we would do is look at how price reacts at 9:30. You can take potential trades before 9:30, but I personally don't really like doing it. So as you can see here, we have the market has been opened. The market opened here on this bearish candle. So what happens when we get this bearish candle? We create a bearish fair value gap, and as you can see, we would not be able to take a trade to this buy side liquidity because this candle here does not close above this inversion fair value gap. So here we have the inversion fair value gap, and then if we just go into replay mode to show you guys, we have the price comes up and it respects this inversion fair value gap. So if we was looking for this buy side liquidity, I would not be able to take a trade to the upside as the candle did not close above. Now if the candle did close above, if this candle here closed above this fair value gap here, so if the candle closed here, then I would be able to take a long, but it didn't. And as you can see, price then takes out liquidity. So because prices took out this main liquidity here, this inversion fair value gap would now be invalid, and I would not take it again. Even though prices came back and tapped into it, I would not take it again. But now we have took buy side liquidity, and what do we have? We have a bullish fair value gap. So if this bullish fair value gap is violated on the 5-minute time frame, we could look for a potential short down to these lows, because as you can see, we have sell side liquidity here, sell side liquidity here, but as well as that, we have lots of low resistance liquidity. So if you watch my video on liquidity, you would know what that means. All it is just basically just trendline liquidity. So we have lots of trendline liquidity sitting there. So let's see if this fair value gaps get inversed. Oh, I played it a bit fast, but as you can see, this fair value gap did get inversed, but it also took the liquidity in the same candle. So this would be a trade that you also would not be able to take. But now price action has took all this liquidity. So price action has took all this sell side liquidity, and what happens? We create a bearish fair value gap here. So let's play at the price action and see if this is a trade that we'll be able to take. And as you can see, this would be a trade that we can enter. As prices came down, prices took sell side liquidity here, and then price has violated this bearish fair value gap, so it has closed above. So our trade would look something like this, would open a long position here. Our stop loss would be if price came back down and closed back below this inversion fair value gap, and the take profit would be this buy side liquidity, and we create equal highs there and then come up and take profit. Okay, so I'm actually going to give you guys one more example, and what I'm going to do is I'm just going to click the daily time frame, go into replay mode. I'm going to look down and I'm going to go to some price action around these points here, and then so go to the 5-minute time frame, and then I'll go to 9:30 of the next day. So let me just skip to 9:30 of the next day, and I will show you guys the inversion trade model from everything I've taught you. Now you won't be able to, you most likely guys, you won't be able to just jump in and take trades using this model, because it does take quite a lot of screen time, and it's hard to find the specific inversion fair value gaps that you need. So without using any daily bias or anything, I'm going to just go to the 9:30 open, which is the next candle. So here is the open, 9:30. So we have, I would just use the 5 minute time frame here. So right now I'm not really interested in anything. We do have this fair value gap here. So if price was to close below, which it doesn't, then I would have wanted sell side. But if we just play at the price action, we have a fair value gap here. Let's just keep playing out price action until I see something that I'd like. Price just dumps. Okay, so here we go. We have took out all sell side liquidity. So we've took out sell side liquidity here. So this would have been sell side liquidity. Then on the 5 minute time frame, we get this fair value gap here. So we have this bearish fair value gap, and then we inverse it. So I would open a long position. My stop loss would be if we get a close back below. Now, I genuinely don't know if this works or not, but this trade, it does look good. I would take profit here, so this would be my first take profit. My take profit 1, just because this is a fair value gap here, so price would come up to this point and then trade back down, and this is also just internal liquidity. So this would be take profit 1. And then take profit 2 would probably just be this point here. But so yeah, let's just see what happens. So price comes back, taps into our inversion fair value gap, takes our take profit 1, and then it would have broke us for break even, because after take profit 1 we move our stops to break even. So as you can see, that is a winning trade using this inverse model. So yeah, all you need to do is just go into your price action, watch price action every day. Just note out which inversion fair value gaps you are valid and which inversion fair value gaps get violated, which inversion fair value gaps don't get violated, and just see how price action reacts. Please don't take any trades if you haven't fully back tested or forward tested the strategy. As I said earlier, it is very easy to take the wrong inversion fair value gaps, and you could lose a lot of money in the markets. But yeah, I hope this is a helpful video, just a quick video introducing you to the model of inversion fair value gaps.